In this week's video, we'll review the latest charts to help us answer the question, is the NASDAQ waving red flags similar to 2000 and 2008? It's always important to note there's a big difference between the utility of short-term timing signals and long-term big picture confirmation signals. The charts that follow are long-term big picture confirmation charts. One of the value-add features of using a systematic approach to investing in the markets is you constantly have points of reference. We're going to walk through charts that we've walked through before. In fact, it's important to note that charts at the front end of the video are the exact same charts that we used earlier this year. Why is that important? If we felt the charts and the message from the charts was relevant earlier in the year, we can link back today and see if anything has changed in a material way. As we often say, this looks noisy and complex. It's relatively simple if we walk through it step by step. This is basically going to be an exercise in pattern recognition. This is a quarterly chart of the NASDAQ here. This is price. This is calendar year 1984 on the left side, all the way into calendar year 1994 here. If we look at ADX here, black ADX fell from high levels and then here turned up from relatively low levels. Similar situation with Bollinger Bandwidth. Was falling, started to rise from relatively low levels. Similar situation with the Kopic curve. Rate of change started from above zero, dropped below zero, recaptured the zero line, and then stayed above. After we could see all of this, and all of it occurred in the early to mid-1990s, really good things happened for a long period of time on the quarterly chart of the NASDAQ. Since we know at some point the market is going to need to consolidate its gains, the look of these indicators was quite a bit different near the peaking process in the year 2000 than it was here at the buying opportunity in the early to mid-1990s. If we fast forward to the first time we covered these charts on June 21st, 2018, we can start to make some meaningful comparisons, and then we'll walk through all the way up to the present day. If we draw some horizontal lines on the chart, so there's a horizontal line moving backwards from where ADX was on June 21st, 2018, you'll notice it's very, very similar to where black ADX was in roughly 1993, 1994. We can make the same argument for Bollinger Bandwidth, the Kopic curve, and rate of change. And after we could see all of this, observe it, really good things happen for a long period of time. Now we can also learn something by comparing the levels at that time to the levels near the major peak in the year 2000. In this case, we're drawing a horizontal line from the levels that were present that we could see and observe and measure as the market peaked in the year 2000. And after we could measure all of that, really bad things happened for a long period of time on the quarterly chart. So if we objectively compare the levels for ADX, Bollinger Bandwidth, the Kopic curve, and rate of change near the peak to the levels that were present on June 21st, 2018, we can see there's a big gap in all instances. This is what an overextended ADX looks like. Present-day ADX really doesn't look anything like that. And we've already shown that ADX in June of this year looked a lot like the level here in the mid to early 1990s in this area here. So in the present day, why is this relevant and why is this relevant? Because the magnitude of the gains here, after all of this, the market rallied for an additional 7 years and tacked on an additional 645%. That is in stark contrast to what happened when we had the concerning look In that case, the NASDAQ from peak to trough here lost 78%. In the June 21st, 2018 video, we said the look of the chart in the present day and the look of the indicators in the present day told us to be open to better than expected outcomes. I think it's fair to say when you see what the NASDAQ has done over the past quarter that probabilistic forecast has been helpful over the last 90 days. And the question at hand in June of this year was, does the NASDAQ look more like a major peak or a once-in-a-lifetime buying opportunity? Thus, if we were going to ask this question again at the end of September in 2018, and now we've added in the updated levels here, we would see that not much has changed at all. The present day, or September 27th, 2018, still unequivocally looks a lot more like this constructive period here and really doesn't look anything like this period here. We can draw the same conclusions for ADX, Bollinger Bandwidth, the Kopik curve, and rate of change. We have a big gap between present day levels and the levels that were seen near the major peak in the year 2000 in every case. And we would not expect a quarterly chart to change significantly in one quarter. We've just added one bar. You can see here ADX black was hovering around 40. It's still hovering around 40 in the present day. Bollinger Band width hovering near 75, still hovering near 75. And we can make the same argument using hard data for the Kopik curve and rate of change. Thus, the conclusion that we drew from the hard data in June of this year still applies. There's no question that the present-day NASDAQ looks more like a once-in-a-lifetime buying opportunity relative to a major peak. And it's always important to note, these are probabilistic statements based on the facts in hand, originally as of June 21st, 2018. Given these levels haven't changed in a material way, we can use the hard data to draw the same conclusions on September 27, 2018. And just as we have done over the past 90 days, in the next 90 days, we will continue to take it day by day with that flexible, unbiased, and open mind. Over the past 90 days, we've continually asked, based on the facts in hand, are we allocated properly? For the most part, let's say with 99% of our portfolio, the answer to that question has been yes, and we haven't taken any action. We've held our positions. It's important over the next 90 days that we repeat that process and remain open to a possible material shift in the data. Since the CCM market model is based on the weight of the evidence, let's say you're not convinced with ADX, Bollinger Bandwidth, the Kopik curve, and rate of change. Okay, then let's look at Williams percent R, the True Strength Index, full stochastic, and the Relative Strength Index, affectionately known as RSI. It's a NASDAQ quarterly chart. This is calendar year 1993. This is June 21st, 2018, and we will take this chart all the way up to the present day. Notice Williams percent R. As the market is peaking in the year 2000, we can see it hits levels that it hasn't seen in quite some time. This looks different than all of this, and this looks different from all of this in the year 2007, early 2008. Here's the peaking process here, and remember, these are not timing charts, these are confirmation charts. We would be using faster charts on shorter time frames, and we would be using these charts to say, do we feel good about the information that we're getting from the shorter term data? Bearish cross, we can see this. Bearish cross, we can see this. Full stochastics remained above 80 and then dropped out. Full stochastics above 80, then dropped out. RSI, for the most part, remains above 70, then dropped out near the peak. This move here in the NASDAQ was so tepid relative to this move here, RSI never even entered overbought territory. That's a sign of weakness right there. And early in 2008, we started flirting with the center line, or 50. That looks quite a bit different than everything over here. So the million-dollar question in the present day, do we have any of those concerning rollover looks in 2018? The answer on June 21st was no, we don't have any of that. This really doesn't look anything like this. This, black above red, doesn't look anything like this. Full stochastics is still well above 80, doesn't look anything like this. And RSI is still rising here. This is an incredibly strong market, and it doesn't look anything like this or anything like this. If we examine the same indicators at the end of September 2018, would we draw a different and bearish conclusion based on the facts in hand today? The answer in this case is absolutely positively no. We would draw the same conclusion. In fact, the long-term charts on June 21st, 2018 told us to remain open to better than expected outcomes. I think it's fair to say, if we fast forward 90 days roughly from June 21st, 2018 to September 27th, 2018, the 7% gain that occurred in this quarter would certainly, in many people's minds, fall into a better than expected outcome. On June 21st, 2018, things were still looking relatively dicey. And once again, this doesn't look anything like this, and this doesn't look anything like this. We can make the same argument for TSI, full stochastics, and RSI. This doesn't look anything, not even remotely close to this, and this doesn't look anything, not even remotely close to this. Notice, these are probabilistic statements based on facts. There's no opinion here about what's going to happen next. We simply take it day by day and continue to examine the facts. And it's important to note, from a weight of the evidence perspective, we could make the same basic argument using Dow charts and S&P 500 charts. The present day doesn't really look anything like the peaking process in 2000, and the present day really doesn't look anything like the peaking process in 2007. Is it possible that the present day evidence could morph into something like this? We know the answer is yes. It could happen, but it hasn't happened yet. There is a reason why we spend the vast majority of our time tracking the health of the S&P 500. If you understand the health of the S&P 500, by default, you understand a lot about the health of the NASDAQ and the Dow. This is a quarterly chart of the S&P 500 1994 into calendar year 2013. This is the exact same chart over the exact same time frame for the NASDAQ, and here's the same chart for the Dow. Notice, all three markets peaked, the major peak in the year 2000, at basically the exact same time, the same quarter. Similar situation in 2007. For the most part, all three indices peak at the same time. The same can be said for the major bottoms. To the right of this green line, good things happen. To the right of this green line, good things happen. To the right of this green line, good things happen. Same exact situation. The S&P 500, until proven otherwise, is the global standard for investing and risk. If the S&P 500 begins to deteriorate, we pretty much know by default that we should start looking at the charts of defensive assets, because most likely When the chart of the S&P 500 begins to wane, the charts of numerous defensive positions will probably start to improve. If I'm trading individual stocks, it's still incredibly helpful to monitor the health of the S&P 500. Why? Because if you know that the major index is rolling over here, the major index is rolling over here, and the weight of the evidence is shifting, you have a much broader and stronger reference point to manage your individual stocks or your individual ETFs. Is it possible at some point in the future this shifts a little bit? Sure, it's possible. Hasn't happened in my entire career. If you understand what's going on with the S&P 500 from a risk tolerance perspective, that's probably more than half the battle. And then, if we look at the health of the S&P 500 relative to other assets, and especially relative to defensive assets, we can gain an even broader understanding about the market's tolerance for risk or lack thereof. The same concepts apply to time frames. Even if you're trading 60-minute charts, it's incredibly valuable to know what the bigger picture looks like. Why? Because when the S&P 500 started to fall in February, if you were monitoring weekly, monthly, quarterly, and annual charts, you knew without a shadow of a doubt that the odds told you that the daily resolution was probably going to end up with a higher high being made. And when a major peak comes, if you're monitoring daily charts, weekly charts, and monthly charts, eventually you will see the deterioration spill over into the weekly charts, and then eventually it spills into the monthly and then the quarterly. The strongest trends are the long-term trends. A quarterly chart is infinitely more important than a 1-minute chart. A monthly chart is more important than a weekly chart, and a weekly chart is more important than a daily chart. Hence, if the big picture is strong, by default, that tells us something about probabilities on shorter time frames. Let's get a quick reminder here of where we may be in terms of the longevity of this rally. 1983 here into 1984. This is June of 2018. There's no need to update these charts because the message is identical in the present day. Market went sideways here inside of this box for 27 quarters. It entered the box here, tested the lower end of the range, upper end, and finally broke out of the box after 27 quarters of indecisiveness. 27 quarters of indecisiveness was followed by 34 quarters of gains. The longer a market goes sideways, the bigger the move we can expect to get. When the market peaked here, we were extended from a base. The ratio of rallying quarters to base quarters was 1.26 when the market peaked. Risk occurs the further you move away from a base. In this case, if we draw a similar box to this box, price enters the box, goes to the top of the box, the bottom of the box, the bottom of the box, eventually clears this level here. This point would be similar. In this case, we were in the box for 82 quarters. On June 21st, 2018, how many quarters were we extended from the base? The answer is 6 quarters. So the extended from the base ratio at the peak here was 1.26. The extended from the base ratio in June of this year was 0.07. And if we update that as of September 27th, 7 divided by 82 brings this number up to 0.085. The longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways, the bigger the move we can expect to get. And as we noted in June, ADX is also telling us this is a more favorable entry point right here than this entry point was. And after this entry point, we rallied for an additional 34 quarters. And how valuable can it be to look at hard data to help us to discern between volatility to ignore within the context of an existing and ongoing uptrend and volatility to respect where the data is telling us it is prudent to now take some incremental defensive action. Just to illustrate the concepts. Hypothetically, if we started with $2 million here and made 650%, our $2 million would be worth $15 million. That's quite a bit different than this point here, where a buy and hold investor in the NASDAQ Composite Index with $2 million would have ended up with $440,000 at the end of the dot-com bear market. And yes, these are extreme hypothetical cases, but like calculus, when we look at extremes, it can help us understand concepts. So the quarterly charts on June 21st, 2018 told us to remain open to better than expected outcomes. After this analysis, in the following quarter, as of the close on September 27th, so we still have one more trading day in the quarter, after this bullish analysis, the S&P tacked on 7.2%, the NASDAQ tacked on 7%, and the Dow 8.93%. We've also looked at annual charts. How much deterioration do we have as of September 27th, 2018 on the annual charts? Well, it can't be much because the S&P 500 is up almost 9% year to date. The NASDAQ's up over 16% year to date. And the Dow Jones Industrial Average, the index, is up almost 7% year to date. There's a message in these numbers here, and it's not an impending weakness message. And just as it was important to execute over the past 90 days in the proper fashion, over the next 90 days, it's incredibly important that we remain open to a material shift in this data. It just reiterates the importance of taking it day by day with maximum flexibility. Often human beings mistakenly look back at historical charts and think this was an easy period. This was not an easy period. Just as there are numerous concerns in the present day, there were concerns about rising interest rates. There was political turmoil in this period here. There were concerns about the Fed. There were divergences. There were non-confirmations. The data allows us to remain cool, calm, and collected amongst an incredible amount of noise and negativity. We can review the data objectively after the markets are closed, allowing us to make prudent and rational decisions. That was true in this period here, and it was true when the market peaked. But the only way any of this works is if we continue just to take it day by day. And we know in advance, even if good things happen for a long period of time, there is going to be an incredible amount of noise and negativity, just as there was an incredible amount of noise and negativity in this period here. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.